All that being said, it works for just about anything that's highly appreciated as long as you hit those benchmarks.
Can a regular person take advantage of this, and how do they get started in protecting their assets for the long term so they can grow into a high net worth individual?
Great question. So our average deal is $2.6 million, and we're deferring somewhere around between $400,000 and $500,000 in liability. Our minimum deal that we makes sense, we found, is $500,000 of proceeds and $100,000 or more in tax liability. So if your deal is $300,000 and you're deferring $50,000 in tax, sorry, it's too small, right? But if it's $500,000 in proceeds and $100,000 or more, then we'd say, why is that? Because our fees will eat up the savings, and it just doesn't make any sense. Now, if you have 1, 2, or 3 of those properties and you're going to be selling them soon, and collectively they add up to more than the $500,000 proceeds and $100,000 in liability, then sure. So that's the first thing to understand. The other part of, I'm not sure if I caught the other part of the question. I kind of lost it. So what was the other part of the question?
Basically just finding out how somebody gets involved in these kind of complex advanced strategies and at what price point. But you've answered that, because I think that there's often a mindset that says, I'm not big enough to take advantage of the tax code opportunities that are available. But people do forget about that primary residence, and it may have gone up in value in areas like Cupertino, where the federal tax code doesn't give a capital gains exemption because it doesn't understand that different markets have different price points. And also, now that the SALT levels are different for New York and California, we have people trying to leave those high cost markets and move to less expensive markets like North Carolina and Georgia. And so when they move to less expensive markets, they're going to pull off those proceeds. And so that's where I think you've got to remember as a realtor to advise your clients that when they've got this giant bucket of proceeds, they don't have to plow it all back into the next house. And that may not be the best thing for them, but the best thing may be to talk to other people and put together bigger strategies. And it's available. This is not just for Rockefellers or for Bill Gates. This is for regular people too. But as Brett said, if you don't have a ton of equity coming out, maybe not yet, but it's something to be educated on so that as you grow your investment strategy over time, you know it's available.
Absolutely. Let me touch on that real quickly now that that's great context, and thank you for sharing that. So this also works for business owners, okay? So we've done veterinarians, we've done optometrists, right? We've done dentists, we've done car dealerships, okay? So unlike the 1031 exchange, which basically is just for this very small sliver, which is investment real estate, that's the only thing it works for. A 1031 does not work for a primary home, okay? The Deferred Sales Trust works for businesses. It works for investment real estate. It works for a primary home. We're doing a horse deal in Kentucky right now. And so if you don't know, if you buy a horse, it's subject to capital gains tax if you can sell it for a higher price. We're doing a Bitcoin deal right now, okay? We've done thousands of closes, okay? And by the way, this kind of answers me a little bit your other question. You know, the regular person, or I haven't heard of it, too good to be true, you know, where, you know, no, it is for anybody. The best analogy I have is you go to your medical doctor and you've been with him for, 20 years, and he's giving you general advice, but all of a sudden you need brain surgery or knee surgery or something very specialized. Just because your general doctor doesn't understand brain surgery in its entirety doesn't mean that brain surgeon has had thousands of successful patients who we like to say have never died on the operating table and have never gone to jail, right? So that's the key. We've survived 14 no-change IRS audits. The biggest one was a $125 million deal in San Diego, and then we've been scrutinized by the IRS for 24 years. So all that being said, it works for just about anything that's highly appreciated as long as you hit those benchmarks. And we're the team to do that, right? We realize that you haven't been thinking about taxes maybe ever, except until the time you sell. But at a certain point, you didn't know about a 1031, right? And then all of a sudden, someone educated you on it.
Exactly.
And all of a sudden, you said, oh, that helps me and my clients? Great. Same thing with the Deferred Sales Trust. By the way, not to be confused with the Delaware Statutory Trust, which are both DSTs. Some of your listeners may have heard of a Delaware, which is just another form of a 1031. We're not a Delaware. We're not a 1031. We are a Deferred Sales Trust.